I'm David Marcus, senior reporter at The Deal, with Gil Menna, head of the Real Estate Capital Markets Group at Goodwin Procter in Boston. Gil, what are we seeing in the real estate market right now?
In the REIT market generally, or on the real estate market specifically?
Both.
In the REIT market, where valuations are very high, and most of the seasoned REITs are able to raise as much capital as they really need to at fairly attractive valuations. In the REIT M&A space, because valuations are high and there's not a significant differentiation in multiples, we're not seeing a lot of M&A activity. That's been something that has overshadowed the REIT sector for some time. But the smaller cap REITs have now moved their multiples up. That's the exception to that rule is the healthcare sector, where the top three healthcare REITs are dominant, and there was multiple differentiation there.
And those REITs would be?
Well, REITs like Ventas, HCP. There's differentiation there, no doubt. On everyone's mind is the Archstone transaction that just finished closing, and that's M&A in a traditional sense, that Archstone didn't go public, but it sold its portfolio to Equity Residential in Avalon Bay. We're likely to see a lot of that activity where larger REITs are acquiring large portfolios, and Blackstone is on everyone's mind. It holds significant industrial and retail portfolios, and so the question is going to be whether or not, in fact, those are taken out to the public markets or whether or not they're sold to existing REITs.
Why would a sale to an existing, already public REIT be preferable to an IPO for an entity like Blackstone or Lehman Brothers in disposing of the Archstone properties?
It's an excellent question. So in the case of Lehman Brothers, LBHI, they filed the Fourth Amendment to their registration statement right before they announced the sale to Avalon Bay and EQR, the dual track process, because they wanted to be prepared to access the public equity markets. But they came to the conclusion at the LBHI board that the net present value to their stakeholders was best to effect a sale. On a pro forma basis, Lehman Brothers would have been significantly north of 50% owner of the company, given its size. And the same would hold true probably for Blackstone. I don't know exactly what the numbers are. And unwinding that position over time, even with a relatively short-term lockup, is by definition a risky proposition. If you can take equity and be a relatively small shareholder in companies like Equity Residential and Avalon Bay, it's much more tolerable from a seller's perspective. Having said that, and then there's also the traditional IPO discount, which you might not see in the context of a sale of a portfolio to an existing seasoned REIT. But the fact of the matter is that for large portfolios like Archstone, for large portfolios like the retail and industrial assets that Blackstone has, there are only a handful of buyers for those assets. There's also the possibility that some of the current property owners that hold large assets will divide them up. Blackstone, for example, sold hotels not too long ago to Diamond Rock, which is obviously not their entire holdings, but a portion of their holdings. So it's really execution risk is the answer to your question, David.
And then also there are privately held REITs that go public through a merger with an already public entity, and I believe you worked on one of those transactions recently.
Correct. So privately held in the sense that they're actually public companies, but they're non-exchange listed, so they don't trade. So the REIT sector has a subset sector called the non-exchange traded REIT sector, which is actually very much the talk of the industry right now because of a lot that's going on there. Those programs are sold generally to retail investors and are finite life by definition and need a liquidity event. And what we're seeing in the marketplace is that some of the more thoughtful and seasoned sponsors of those non-exchange traded REITs are saying what they mean when they affect liquidity at the end of their programs. And in some cases, in the case of Cole Credit Property Trust II, well within several years of ending their program, decided to sell their company to Spirit Realty, and that's announced and has not yet closed. That's a fine example of an organization like Cole that has decided to affect that liquidity through an exit of one of their programs to an existing publicly traded REIT. In the case of Spirit, it had been, and Tom Nolan's the CEO of Spirit, It had been taken out into the public markets last year, so it was a relatively new company, and it was a really great transaction from Spirit's perspective too. The market's reception has been very good, and the Spirit, the board was very thoughtful to buy that company.
Last year, in terms of deal and dollar volume, was a very strong year for REIT M&A in the United States. What are you seeing this year as you look out over the next several months?
So, well, I think that, again, as I mentioned, there's not a lot of differentiation in multiples. So I think that with REIT valuations high, it's hard to see intra-REIT industry, public REIT industry transactions. There's still a handful that people have always talked about, natural acquisitions or combination transactions that should be taking place. At the end of the day, the question really is whether or not the social issues that we've always talked about in our industry will get in the way, whether or not boards can come together and affect a transaction that makes sense on paper. So there are a handful of those transactions that everyone has talked about for some time. I wouldn't be surprised to see one or two of those transactions. In addition to that, there has been a lot of activism in the REIT industry lately, most recently in the context of the Commonwealth REIT. And so I think that it's probably going to likely be the beginning of additional activism. So at the end of the day, when hedge funds and other activist shareholders invest in companies, it could be public REITs or other companies, generally they don't wait around too long until they want to see some action if they feel as though there's value being left on the table. So I think that that's something that we might see a little of. At the end of the day, the REIT industry hasn't seen a lot of activism. We did see activism in the C Corp area with heavy real estate assets on REIT conversions, which we've talked about before. You're seeing that now you saw with American Tower, but there wasn't an activist approach. American Tower just thought to do the conversion, but you did see activism in the Iron Mountain situation and in the prison REIT sector too.
Great. Thanks, Gil. I'm David Marcus for The Deal.